in the buy and hold portfolio, we're net short Yang, which is pushing up really, really furiously right now. So,
We are live.
all right.
Okay, great. Well, welcome everybody. Thanks for joining us for our Thursday Trade Alert, where we play emerging markets, TLT, GDX. We squeaked out a tiny gain on emerging markets after all. And I want to clarify the trade alert, just make it crystal clear. First step is to get rid of everything we had from last week related to emerging markets. So that means buying to close your short call option and selling to close your long put. Now, if you were exercised and assigned, then you're just long your put, sell that for a nice little gain, and that will represent the same profit we made. So that's part one. Step two, remember how many shares of EEM you owned, because for every 100 shares of EEM you owned, you're going to buy one May 15th, 2020 42 EEM put. So for most of you, per 75,000 following the program, that represents buying two May 15th, 2020 42 EEM puts. Okay, so that's a 90-day expiration and a 42 strike. Now, if you're in our boot camp, you'll know why we chose that strike and that duration. Essentially, you can plan on selling that in no less than 45 days. And after we hit our target of going below 40. So just to simplify life, if you see a put option or a call option that we're long, and I have purchased, let's just say in this example, 90 days of duration, that means I want to sell it in 45 days or less. Now, we're not going to get into the mechanics of why that generates the best profit. We spent over 2 hours going over that in our boot camp recently and are just barely digging into that. So it's a lot of information. But bottom line is we will pick a strike that's halfway where we think it may reach, and we'll grab twice the duration. And that'll really help you maximize the profits in these predictions. So I'm looking at a minimum of a 10% sell-off in emerging markets in the next 45 days. Now, will I add to this position next Thursday? We'll see. But for now, this is the trade alert for emerging markets. So again, to repeat, one way or another, if you're still holding the full position, again, buy to close your $40 EEM short call and sell to close your 44 EEM long put. So again, we sold the call, we bought the put, and that was while owning the underlying ETF. Now that trade alert is highly optimized for a flat or down move. Looks like things are really starting to crack around the seams. So we're taking this to the next level by just simply owning the long put going forward. Okay, now the next part of the trade is to remain naked long the TLT and GDX. That means we have no options guarding either of those two assets. Most likely, this can be the case for at least the next several weeks, potentially months, while we carefully watch companies like Foxconn as a great leading indicator to see when China is going to get back to business. Right now, China is completely dead. There's nothing going on in China. So until we see some action spurring, some coal burning, some nice pollution coming out of the area, we're gonna have to assume that things are not all right, and also that other surrounding countries are going to make the same draconian measures that China just made to curb the virus. So the headline that's freaking out people today is South Korea is now having a pretty dramatic outbreak. So, the whole let's just move production from China to Vietnam's not going to work when Vietnam's about to make the same measures that China's had to make to curb this virus. So that's kind of the big picture of what's going on. Let's just look at the audit of the return. So last Thursday, we were at 44.31. And today we're down to 43.63. So the underlying asset lost 68 cents. And our short call took care of that. It gained 70 cents. Now, if we had just traded flat, that short call also would have delivered a profit because of the time premium eroding. So that's the big difference in the inverted option collar versus just going straight up long with a put. Okay, the put option, we paid a debit of 34 cents and squeaked away a little gain here today at 45 cents. So net, we're up 13 cents a share. Big whoop, basically flat, 494 profit in our portfolio. But it does look like things are starting to crack, which means we have some opportunity here. Now, if you remember on 1/27/2020, we issued a emergency alert as the coronavirus went from something that I was thinking was just headline noise, and we were seeing the case count dramatically rise over that weekend, doubling every 24 to 48 hours, only to slow down ahead of course, Apple's earnings that week, and now it's ramping back up. So we went long naked TLT GDX that date. So I'm tracking the P&L from that date, and we'll continue to do so until we start to add some options and change the strategy on these two assets. At this point in time, this is my favorite part of my highest confidence trade is in being long TLT GDX. Emerging markets, I do think we have a great opportunity, but as you all know, central banks can distort markets and do all kinds of crazy things. So we'll see how much money printing and rate cutting can happen in a 60-day period, as this quite likely will force surrounding Asian countries to start taking the same measures that China has had to take to curb the outbreak. Our total return popped. Okay, so again, we're up 289 on TLT and up 73 cents finally on good old GDX. And we've been watching spot gold break past 1600, so it's just a matter of time to see GDX pull up a little bit. Okay, so that's the review. The SPY put has kicked in already, and I'm not quite ready to bet down on the SPY yet, as I still think we'll see the same knee-jerk movement where people aren't ready to go all in on bonds, and they're just going to continue rotating out of Asia into U.S. products. So we'll keep a close eye on that. I'm really concerned that my thought, why isn't the SPY already crashing, is likely that the trade war and the threat of massive tariffs, which were supposed to be delivered in December, which would primarily have hit in the electronic industry. I believe that did cause a lot of front running on the tariffs to build up some pretty significant inventories. So we're not yet seeing the pain hit supply chains. But if China can't get back to action within the next 2 to 4 weeks, I think those supplies are going to start to dwindle. And we're going to start seeing American companies having to warn investors that, hey, we're not going to be able to meet our revenue targets because we can't get the supplies we need to produce our products. So keeping a close eye on that. The other thing I'm looking for is actually a scare in the US for the coronavirus. Now, so far, the growth of the reported case count in US has flatlined. Whether you believe that or not, I don't. So I think that's a wild card that'll pop out one day, is that, oh, actually there's several hundred infected patients in the US, not 15. There's just no evidence to back that up yet, other than just looking at these cases from, for me, I'm looking at 3 cruise ships that have had Americans on it that are now back in the US quarantined. Plus, we sent in a big rescue mission and picked up at least 220 people out of China. There's just no data on that right now. So whether they're keeping it hush-hush or what, really doesn't matter. We got to work with the news flow we have. Right now, the negative news flow is centered around all these countries that play a big part in the EEM ETF. Now, if you're following the buy and hold portfolio, no change. We're still long SPY, long TLT with the 2-to-1 ratio. We're still long GDX with the 2-to-1 ratio. And we have 1 Yang and $44 in cash. Now, you could add on to that today's put, but I haven't thought about how that would essentially work into the buy and hold. but we're putting out 2 puts per 75,000 following the strategy. So if you're only following the buy and hold with 750 or 7,500, you'd be taking 10 or 100 times the risk that I'm recommending in our option program. So keep that in mind. And I can definitely hand answer any questions, but you do have that exposure to a degree with Yang. It's a little bit different. It's more based on FXI and not so much the entire area, which I believe is going to have a slowdown here. Okay, below that, we have some screenshots just showing you the prices where we got in and out. Likely, you guys are going to get a little bit bigger profit on the inverted option collar and a little bit more expensive starting point on the new put, but just by maybe 10 cents. So it'll be fine because we're actually trying to hit a considerable move on emerging markets. Now, if we're wrong, because central banks are just going to buy up everything under the sun, we're not going to lose a whole lot. If we are correct, this trade can have a very large return with low capital at risk. Okay, so that's a good review of the trade. Let's go ahead and take a quick break for Q&A. And once we finish Q&A, I'll flip over to the iPad, look at some charts, and then we're going to prepare for the boot camp coming up in about an hour and 45 minutes, where we're going to look at a lot of data related to Hong Kong and China in terms of trying to look at other ways to predict pain in China and how to profit from that. Okay, Ryan, if you want to go ahead and unmute everybody, and we'll see if we have any questions out there. Oscar, any more scare in the U.S. hospital system that you can report on?
Not yet. Not yet. You know, there's apprehension. Let's put it that way. There isn't a scare yet. A lot of apprehension, and you know, the antennas are raised.
Yeah, sounds about right.
Speaking of which, I got to run on you, Jason. Thank you for the update.
My pleasure, Oscar. Thanks.
Thanks,
Look forward
Oscar.
to the replay here.
Excellent.
Jason, I have a question that I should know the answer to, but why did you sell the shares of EEM?
Good question. So the inverted option collar takes advantage of a flat or down move. So that's where we sell it in the money covered call. And so if we're expecting a down move, but it's not really happening yet, that's a smarter play. It helps you reduce the cost of your put. And again, allows us to make some profits if we just go flat. But at this point in time, it looks like we're on the verge of a real crash in emerging markets. So a more aggressive trade is just to buy the put and to stand out of the way. So that's the move today.
Okay.
So I think Jason explained it really well earlier to William. You know, that's a great strategy when we think it's going down, but when we think it's going to drop like a rock, it's better just to have the put underneath and not have the underlying asset.
Exactly.
Okay.
So you would lose more if you owned the shares and bought the put than you.
Yeah, you got it. We make more money just being long the put if we get a dramatic sell-off. So risk management's really important here. That's why you don't see me putting a huge bet out where we're going to risk losing a ton of money here.
Right, exactly. And Julio, do you have a question, bud? I see your hand is raised. Go ahead and unmute your microphone if you do have a question.
Hello, you were talking about the boot camp. Is that part of this display that you have here, or is something different?
Boot camp is a very intensive weekly program. You basically get 2 pieces of content a week. On Tuesdays, I give you videos and homework. On Thursdays, we do a live webinar. In these live webinars, I either teach you options trading, futures trading, Forex trading, macroeconomics. And then on top of that, we also take a break in between when I don't have new content. I teach you how to fill out your spreadsheet so you could trade like a professional hedge fund manager and not just kind of winging it. It also has some bonus trades. So anything that's not covered in these 4 ETFs will be traded in the boot camp. So the advisory service will not touch anything. And that's what we've come to find after doing this for 14 months, is that we're better off keeping the advisory locked in on those 4 ETFs indefinitely. That makes your life really easy to follow and track the program. And it really stops mistakes happening from our clients. If I'm changing the underlying assets, I've noticed people just don't even see it sometimes. A lot of mistakes happen. And the goal in this program is to actually ensure that all our members get the same results, whether it's good or ugly. I just want to make sure we're getting the same results at the same time. So that's boot camp. Anything that's outside of these 4 ETFs, which primarily the trades, just for a heads up, what I have in mind currently. Okay, call options on the VIX. Very lucrative, very risky, has to be very well thought out and timed. That's a trade we would do in the boot camp. That's 1. 2, any kind of currency play where we use the futures market or Forex market really takes a whole new level of understanding and education. So any plays in that is also part of the boot camp. So those are the 2 key plays right now. The third play would be carefully watching the corporate credit market crack. Specifically, the junk bond market, I believe, will be the first to crack. So those are 3 high risk, high return opportunities that we're focusing on in the boot camp outside of just general education. So it's really a program that the main selling point is we're going to enhance your education dramatically and make you a better prepared investor. But on top of that, the cherry on top are some of these bonus trades. Now, a lot of people want to join it just for the bonus trades, but I would still argue the real reason to buy it will be to enhance your education.
And Julio, as we were talking about earlier, if you did want to learn the option program, just options in general, learn it inside and out, have Jason kind of coach you through how they work, why they work, when you want to use them. Great program for that as well. But yeah, so definitely an option for you. But yeah, I think when we talked, you said you kind of want to do your full-time job, sit back a little bit more. The buy and hold may make sense for you to start with, and then slowly scale into the boot camp. Or a lot of our customers will they'll say, hey Dean, let's do the buy and hold and the boot camp combined, or you can combine it with any of the programs. But just kind of we have our alert service. That's where we hand you the fish. All you got to do is replicate it with your account. The boot camp is a lot more intensive, just kind of at a 10,000 foot level and easy to understand your first time in. So
yeah, so for example, we're just getting started with the options education, and I've studied every option course you could get you could get your hands on. This sort of starts at a whole new point. So far we have at least 4 hours of content. We're just at the tip of the iceberg of trying to understand how all this works. So for me to simply tell you, hey, we're going to pick a strike that's twice the distance, or we're going to predict a $4 down move on EEM. So we're going to buy the 42 strike. And I think it could happen in 45 days. So we're going to buy 90 days of duration. If you want to understand why that is the way to go, your boot camp will really teach you that. But just to get a feel for that, it does take quite a bit of an education to get to that point. So we simplify it for you in the advisory, so you could just take the trade. Let's see what other, and we got a lot of people in the boot camp who are live right now. So, Karen, what's going on?
Hey, Jason. I was just trying to go back into the boot camp to see which module it was that you talked about, what you just spoke about. I must have missed that one. And I'm going,
Karen's trying to get me to let her front run the trades on email. I'm just kidding. Karen's
Well,
Karen's question yesterday was, "Are you going to double down on this or what?"
yeah. Well, and then of course, look at these crazy announcements out today. You got, E-Trade, getting bought out by Morgan Stanley. And I mean, it's all merger mania. Here we go. So I'm looking at this going, oh, crap, what is going on? Oh, I can't.
So here's the order I'd like to see things happen. First, I want to see stock market having trouble. Maybe not FXI and Yang, but we are seeing those start to have some trouble. And also, we're going to look at we're counting on China running out of dollars. So that's happening. So that's good news for that trade. But yeah, I think the order is stocks, then the currency, and then the Chinese currency, and then the Hong Kong dollar last. I think that'll be the order the dominoes fall here.
Hey, Jason, I know you won't forget, but the spreadsheet, to fill out the spreadsheet, when do you think that'll come up?
You should have your spreadsheet, Ron.
I do have it, but you said you were going to have a seminar or something to.
Yeah. Oh, when are we gonna start filling it out together? Yeah. So today we're doing the Hong Kong review and looking at. I have 99 slides just from trading economics. Not some kind of fancy dancy thing. That really gives you a great look at what's going on, macro picture with Hong Kong and China specifically. We're going to talk about the timing of our trades, which I just outlined pretty well.
All right.
Stocks crash first, currency devalues second, and the Hong Kong peg breaks last. That's what I believe is the flow. So we're just going to review that in detail today. Next week, we'll do because I'll need another week to get the call option part 2 ready. So next Thursday, we're just going to sit there and fill out our spreadsheets together.
Okay, that's great. Thank you.
And then the next week after that, I do anticipate having call options part 2. So we did call options part 1 a couple weeks, like a week or 2 ago.
Yeah. So next Thursday.
Yes, sir.
Great. Thank you.
Yep.
Hey, Jason, this is Mark. Where do you see the SPY heading in the near term?
A tough one. I think that the SPY is going to have strength until we need to see. So we're seeing a big divergence in the SPY, which is really bad. We're seeing like the top 5 companies just gobble up all the returns. They're the only ones staying strong right now, while the rest of the pack is weakening. So I'm going to be
You look at the VIX today, by the way, while you're looking at the SPY.
Got a little pop on it. Yeah.
Oh yeah.
Yeah, so I'm not quite ready to get aggressively bearish on the SPY. Not until I see those leaders start to crack. Probably Apple. I think once Apple is really having trouble getting iPhones produced, that could be the big sell-off, at least short term. But again, I'm also going to be looking at what's fueling the stock rally. I'm going to be looking at supply chains breaking down. So I want to see supply chains breaking down. I want to see the surrounding countries starting to go into quarantine. I want to see Foxconn just can't get back to work. And I want to see perhaps some forward guidance starting to go from so lofty to negative, as well as I think that alone would be enough to get a good sell-off. But then we got to worry about corporations who their time horizon is infinite. They still have access to cheap capital. So yeah, it's during the last 14 months, there's periods where it's much easier to predict one asset over the other. For me right now, predicting the TLT and GDX goes up is easy. But I'm very scared to bet down on the SPY because I think we're going to continue to see a lot of money. I think we're going to see Asia print, try to support their stocks. All that money floods into the stock bond strategy in the US. So I'm not quite ready to get bearish on the SPY yet.
Okay.
And we're seeing a lot of funny business in the futures market too, as we know. So yeah, that's it's hard to bet down on the SPY yet. I think after emerging markets has had a significant sell-off, and they still can't get their act together and get production back up and rolling, that we might have some good shorting opportunities on the SPY. But if they can get back to work and, you know, just make people go in there sick or not, that's something I'm kind of, yeah, supply chains breaking down. That's the bottom line.
I'm trying to find it again. I thought it was on Zero Hedge, but there was an article. I don't even remember what it was now. I'm trying to find it. Something about voluntary quarantine of like 45,000 people in California.
Oh, really?
Yeah, and I think it must have had something to do with that woman they let go by mistake, you know, and then they got her back on, you know, that they brought over, and then they got her back in quarantine again. But I mean, the exposure, I don't know, you know.
Yeah, so I'll probably be happy to buy the, I'll probably keep buying a put that's about $3 below the SPY and
Okay.
keeping us along the TLT until shit really hits the fan here. And I think
Yeah.
that's 30 to 60 days out. And that's just my best guess at this point.
Yeah, of course. I'm just today with that VIX popping, you know, because I mean, all this stuff is, the rumors have been coming and going, and this and that, and the VIX hasn't moved very much. You know, all of a sudden now it's popping at 18.5%. Okay, that's about it's not a lot, but it's the most it's been throughout this entire. Okay, now it's down 18%. So you know, it's the most it's been in this entire drama the past month. So, you know, I'm wondering, okay, they're starting to wake up out there, you know, in the market.
Anybody watch the, just total side note, anybody watch the Democratic debate last night?
As much as I could, I had to keep flipping off. It was just so bad, but yeah.
Oh man, I was laughing so hard.
I know.
Boy, good old Pete, man, he was slamming those guys. I was cracking up.
Yeah. He sounds like he's being coached by the Obama team. You know, let's tell everybody else how to run their lives.
He's a good debater for sure.
Well, he
But
talks
I think
that shit just like Obama used to do, right down his nose. Give me a break.
Yeah, I think Bernie walked away looking the best out of that yesterday. So there's a new risk for us to all worry about.
I don't know. I can't. I can't listen to any of them.
Oh, you crack me up, Karen.
Oh man. Well, you know, it is what it is. Thank God I can still, you know, I can still say my opinion until they come rushing to my door, and then they better watch out because I'll defend myself.
Okay, guys, I'm gonna mute this setup, get my chart system up, and I'll be right back.
Okay.
So Dean will keep you guys entertained for a few minutes here. And Ryan, if you could allow the Jason account to be able to share its screen in a minute. I'm going to switch my audio and visual to the other account. Otherwise, I think it's going to echo through.
All right.
Okay, cool. And just real quick, guys, just this isn't on the screen right now, but just taking a look at futures markets. Just seeing what the rotation looks, you know, just kind of getting a better feel if this is rotation or if this is panic sell. Really can't really make a determination at this point. But yeah, watching the lows here and just some levels to watch, folks. So it's 3,309.25 was the level that we dropped to in the futures market. When things get nutty, I like to always watch the futures market because it has the most volume in it, more than equities. So it's just good to watch in times like this. But yeah, so far nothing too nasty. But yeah, it's just, you know, so interesting too because we have that parallel, right, where yeah, U.S. markets will sell off on coronavirus scares and that type of stuff. But at the same time, you have investment banks and hedge funds, CTAs taking money out of China and shoving it into the United States too. So, I think so. When everything started, the scare of the coronavirus, and it's good for you guys to know this, China went limit down at 3.5% down. The first day they made, I guess, what they would consider a halfway truthful major announcement. But yeah, it actually went limit down 3.5%. That next day, SPX or SPY, we'll just use that as our reference, was down 6 points the next day in the United States. But so still haven't seen that same knee jerk. And the whole reason, guys, is because we just don't, we're just not in the same position, right? We don't have the massive coronavirus at this point, at least that we know of, right? So that's what the markets are telling you. And then you have that rotation out of China's markets into the US market. So, that's probably why we haven't seen the 3.5% down move here. It's just apples and oranges currently. But and all of this in the end, guys, is short-term headwind will be a long-term tailwind. We'll just bring more capital into the United States market. So,
how are we looking on the new visual and audio?
It's fine.
Nice. And the audio, no double echo or anything like that?
Nope.
Nope.
Excellent. Okay. So I'll flip through some charts. So on the SPY, we basically had the 336 put. So that's making a nice little profit for us. We could fall off a cliff here on the stock market today.
Sure is.
And we'll be just perfectly fine. So that's good. Good for us, bad for everyone else. I don't think this will be, unless we really see supply, again, that Foxconn specifically will be the company I'm going to focus on in terms of trying to predict the SPY. So if Foxconn can't get its act together and start producing iPhones, I do think Apple could take the SPY down single-handedly. So that'll be our main thing to watch on that. Look at emerging markets. This could go much. If things go the way I think they'll go, I'll be willing to continue adding to this position every Thursday. Because if we go look at some of these crashes they've had, in 2009, it went to 20. Okay, this is back when we were buddies with China. 2015, again, you got Biden and Obama just telling China, do whatever the hell you want, went down to 30. So we could get a pretty epic crash. The new administration is the exact opposite. They are aggressively trying to slow down China and put the pain on them. So our current put option can go up a lot, but we can get much more aggressive if we do things start to unravel, as I anticipate they may. So again, if we look at the time range on this one, let me zoom in on a week. So I'll go to a daily chart. So you can see in the grand scheme of things, this could crash far below 42, where we put our first put. So that's where I'm looking at in emerging markets. Now, again, emerging markets gives us exposure to Hong Kong, China, Taiwan, South Korea, India. And they're going to be the next to potentially have to start doing some lockdowns and some quarantines, which could slow their economies down. Now, if we look at what China did, they tried to outlaw selling their shares, and they pumped $250 billion into the banking system. So that gave them a little bit of a delay in their sell-off in their market. So I could see something similar happening in the surrounding countries. The key indicator to look for this whole trend to change is the dollar. And remember, we had the line in the sand at 98. So we started off the year expecting rainbows and ponies, that China, US are best friends, and that there'd be no escalation, no problems, and China will be able to stabilize at 6% growth target and keep the rest of the world growing as well at the same time. And that would indicate the dollar should be weakening, and that the SPY in emerging markets should be going up. But emerging markets, which was trading at a PE multiple of about 15 relative to 18.6 on the SPY, well, that means emerging markets not only should go up with the SPY, it should outperform the SPY. And pretty quickly, to start out the year, that did not happen. The dollar did not weaken. And we have had crisis after crisis. First, the Middle East conflict, which does seem to be quietly bubbling up as much as they try to keep a can on that one. But now the coronavirus just cannot be contained. In terms of negative news flow, big headline overnight was South Korea is now telling people to stay at home as their case count, I believe, doubled or went up by at least 50%. And again, I believe not just China, but especially the US are trying to cover this up as much as possible. So I think the worst news is yet to come. So the easiest way to track this, to know when we need to reverse our trade, is when the dollar index stops rising. And so remember, if you owe debt denominated in dollars and you're a foreign country or corporation, which most of their debt is denominated in dollars, well, you're in this situation where you're selling your currency to convert it into dollars just to pay the interest. So there's a never-ending demand for the dollar, whereas if you're going to slow down exports and imports, well, your currency over there in Asia is going to lose its demand. And so that's the big picture here, why the dollar index going up is very bad for emerging markets. And in the short term, the knee-jerk reaction, again, is flood of money into US products. So this really simplifies our analysis to a degree. And keep in mind, my favorite investors were all betting the exact opposite of what I rotated us into when we sent out that emergency alert. So it just goes to show how quickly things can change, and why you got to know your own shit and not rely on everyone else to predict these market moves. So dollar index is a very good giveaway for us. I'm halfway through reading the Fed minutes, which were released yesterday. The first 10 pages were really about how they essentially manipulate the currency markets. Now, the government does not want a strong dollar. So just because of the strong dollar alone, I believe the Fed will have no choice but to cut interest rates in the near future, even though their Fed minutes, which had barely started to get a squeak of data from the coronavirus, were saying that they thought everything was grand and that rates would most likely stay the same. However, if there was a bigger chance of an increase or a decrease, it was a bigger chance of a decrease. So if we are going to have rate cuts, that artificially will push the TLT higher, which again makes no sense, but that's the way the economic system works when central banks try to change the outcome of what's happening in the world. So I believe TLT can go parabolic here the longer that China and its surrounding territories, or neighbors, not its territories, remain shut down or start to go into a shutdown. So again, this strategy of being long the TLT and SPY works until we get near the effective lower bound. So I was just starting to get into all the juicy stuff about what their intentions are with interest rate policy. I'll cover that more most likely. Well, we got a lot to talk about just with China, but some interesting things they're talking about in terms of what would make them either start or stop QE, and what would make them, instead of just having, a lot of people think once we get to 2% inflation target, then they're going to suddenly switch course. But now they're talking about basically having a range where investors should expect no change, a range where investors should expect a rate hike, and a range where investors should expect a rate cut, versus just kind of being black or white. Now there's this medium range they're talking about. Also, they are planning to slow down repo, as well as the what they call not QE, picking up the T-bills after we get through tax season. And again, if we have crisis around the world, that creates a huge demand for U.S. debt products, and will help them accomplish that goal of wrapping up QE, as well as probably not doing the rate cuts, but I can see them dramatically slowing down repo, as well as not QE, as they put it, as they intend to. So that's what we're looking at with the Fed minutes. I'm halfway through, so I'll give you guys a more detailed report since I complete it. It's 20 pages, well written. If you like that sort of stuff, I highly recommend it. I'll definitely provide the link as the key document to study on your Tuesday update for boot camp members, although it's quite easy to go find those Fed minutes if you want to read it on your own and you're not part of the boot camp. Let's pull up, let me pull up my chat box, see if there's any questions really quickly. Okay. Next thing I like to do is look at the German yield. So we may not trust China, but the 30-year Bund from Germany has acted as a great leading indicator. And it is dropping. Any question out there? I guess not. Okay, so this is about as far as we can zoom out. Crunch this down a little bit. The green line again is the German yield, which famously went negative last year. And now it's back on track to go negative once again. It's sitting right above zero. So what a joke. You go lend $1 million to Germany. Over the course of 30 years, you get paid $1,000 back. So why on earth would you buy that bond? Well, you buy that bond because you think Germany's in trouble. They're going to stimulate their economy by cutting interest rates, trying to spur investment, spur borrowing. And again, that drives the value of bonds higher. And again, they're not expecting some Joe Schmo to pick up the tab. They think the German central bank will do this later down the road so that they can flip this bond for a profit. So that's the big picture of what's happening in the bond market. And you can see it has dramatically got ahead of the US Treasury, signaling once again, big trouble in China. And China is your main importer exporter, driving all the growth in Asia. So if China's not growing, emerging markets is in some deep doo-doo. And this just shows you visually just how far the US Treasury yields could fall. And at a time where we are creating massive, massive deficits, you better believe the government is going to love this opportunity to sling its debt outside of the US banking system to foreigners at record low yields. So just how low can this yield go is relative to who we have to compete with to sell our bonds to. And essentially, the lower Germany and other competing bond markets drop their yields, the lower we can get away with it. So this will help us figure out when we think we've hit a maximum potential return on the TLT. So go back to just the default. Now, assuming the US is not absolutely nuts and ready to go into negative yielding territory, which they just very well may be, my belief is that we could see this get into the 170 to 175 range as an ultimate top. To go beyond that, we would have to get into very extravagant monetary policy that's never been used before. But we are seeing Japan and Europe already starting to try out this policy over the last 5 years. And they spend a lot of time in the Fed minutes talking about how well that's worked out for those two areas, which baffles me. As far as timing, they tend to try to, they know there's a big problem when we get towards that effective lower bound. So they're going to try to drag their feet as slowly as possible in terms of rate cuts. So I could see this being a 25 basis point cut every 3 months. So that gives them at least a year and a half where they can get away with this. Now, again, I don't think they'll do that unless they absolutely have to. And this all depends on when China can get back to work as well as the other emerging market countries. So at some point, I will want to bet that the world's not going to end, that the coronavirus will be stuffed out, and that stocks will go up and bond yields will rise. We're just not there yet. So we'll be ready to go from naked long TLT is phase one. Phase two, once we think we're getting near a top, I'll start buying some puts underneath like we are on the SPY, expecting this just to keep melting up, and then eventually switch to the inverted option collar, and potentially for a brief time period, just buy straight up puts like we are on emerging markets. So that could be potentially the life cycle of how we trade the TLT. So right now we're just naked long. As we think we're getting near a top, I might buy a cheap put just for some downside protection. When it does look like we're at a top, I might do the inverted option collar so we profit from a flat or down move. And then once it does look like, again, ponies and rainbows, everybody's back to work, then we might flip to just an outright put until we get back to normalized interest rates, which, if you remember, I believed was in the 120 to 130 range. So could be quite a cliff to fall off on the TLT once things go back to normal and China's back to business. Let me pull up my Bloomberg. Audio still look pretty good, Ryan? How's it compared to the other setup? Is it as good or
Not even close.
not even close? Yeah. Well, these are just the AirPods.
Gets the job done.
It gets the job done. All right. Well. Okay, so now I'm going to look at some commodities. I need to get Dr. Copper up here. Holy cow, look at that gold chart. Absolutely insanity. So again, for gold, we like three things. Number one, low interest rates, which clearly are going lower or staying low. Two, quantitative easing. So if we can't dig up gold very quickly, but we can sure as hell print money quickly, well, then the same pot of gold is going to be worth relatively more fiat currency. So pretty simple calculation there. Last thing that does give gold a boost is a little fear, but that's not the primary reason we buy gold, really just the monetary policy. Now, of course, the fear is what drives the monetary policy.
Hey, Jason,
So-
did you hear the comments from Clarida today? Was it today, I guess?
Clarita,
Yeah, Clarida, that's how you say his name. Yeah, Richard
Clarida.
Clarida.
No,
He,
what was it? Was it
well, I thought that might have been a little bit why the market was moving a little bit, because he sort of indicated, and I didn't hear it specifically, I just heard the aftermath, that it's, not to assume they're going to drop any more rates. And of course, the market is assuming that and probably building it into the cost of the equities. But and all of a sudden, boom, the bottom dropped out and the market started going down. So I don't know, but
No, they've been saying they're not going to cut rates every rate cuts.
And then they do it. Yeah. Okay. Well, I'm just throwing it out there because I just heard it today.
Yeah, the Fed minutes are all saying they think everything's hunky
Yeah.
dory too.
Yeah.
I'll check that out. I saw a little piece on it. I like to read Yardeni research every morning, so that's about 10 to 20 pages.
Mm-hmm.
It's usually the first thing I'll read. He's pretty high
Better
level.
I always can't handle that.
Yeah, he's pretty technical. Him and his wife have a really good newsletter. And then I'll go read the Bloomberg updates, and then I'll start going through Twitter, and then also I got to keep up on these doctors and what they're seeing in the coronavirus, just to get a feel for. Let me pull up the Dr. Copper.
Yeah, and silver's popping too, so that's kind of interesting.
Yeah. Okay, so here's Dr. Copper. This is a good health indicator of whether we're building or not building. And again, they printed right here, they printed $250 billion bucks, so we got a little pop. But if we look more like a 6-month view, you can see before we went and printed $250 billion and pushed it into the banking system, Mr. Dr. Copper was falling off a cliff. So again, this bounce, I'm gonna say, is just funny money buying up, just trying to promote stabilization so that people don't freak out as China potentially can stay locked down longer than people are anticipating. Same thing in oil. Fall off a cliff. If we're having, again, rainbows and ponies, and China is going to get back to stabilizing their GDP and not having a crash in their economy, then oil should be being bid up by China. And it was crashing like a rock. And then, of course, $250 billion gave it a little short-term relief. And the currency market, this is starting to show weakness. So this trade could be soon. The concern I have about shorting CNH is I know very well they can easily manipulate it. So I don't only want to see China in some pain. I don't only want to see China losing its dollar supply, which are both happening. I also want to see it to have some sort of advantageous benefit to China, which would mean they're going to break their contract with the U.S. to keep it below 7, which would anger the USA. So we're seeing some geopolitical tensions in terms of attacks on Huawei. So 2 really key companies to study here are Huawei, in particular, what the U.S. is doing to try to stop Huawei from taking over the phone industry and the 5G industry. And then 2, when is Foxconn going to be able to get back to production? And all of this is happening right there in China. So that, if we had known that the coronavirus is coming, I guess if I listened to Karen saying that their body language was BS when they signed that trade deal, we could already
Works
be up
every time.
Yeah, we could be up a lot on that trade already. Something like $5,000 a futures contract. But the big picture is this puppy could devalue all the way to 14 over the period of. So when I was born in 1985, this exchange rate was at 2, and it went all the way up to like 11, and then they tightened it. We can only see to 2015 here.
I'm sorry, what date was that again?
February 16th. So yeah, my birthday was just on Sunday.
Oh, happy birthday. Yeah, but what was that year again so I can pass out?
1985.
Oh, okay. Okay. I'm grabbing my chest. I can't believe it. Oh my goodness.
So I'm being timid on this trade, but the big picture is this thing could devalue way more than a little blip. So we have a huge potential profit to make betting against their currency. But I do want to see it. I want to see an advantage for China to let it just go. And at this point, if they still think that the US is going to be accommodative to them, it's really not in their advantage to allow it to slip too much. So I'm still holding off on placing that trade, even though the economic factors are really in our favor at this point. But maybe soon we might start slowly getting into that trade. The
You
risk
keep
of it,
I was going to say, you keep teaching me technicals. I'll teach you my intuition, and together we'll all do really well.
yeah, sounds good.
Yeah. Wow.
Here's the other trade we're looking at for the boot camp is the Hong Kong dollar. I think they have to lose control of their core currency before we're going to see this peg break. And this would basically mean the Hong Kong exchange goes down, which is where Alibaba just did a huge fundraising. So if this peg breaks, that is going to be a huge systemic pain for the market. So this will probably be the last trade we put on, but it's one which you have to be positioned. It has very little risk to move against you. And it may just happen overnight in a snap. So it's not one where I see us being able to play it patiently for the course of a decade, like shorting the Chinese currency. So if I do see that going above 7 and staying above 7 on CNH, that could be a good indicator for timing on this Hong Kong trade. And all right, guys, we did go for an hour. So I think that's a pretty good review of what I'm looking at. And portfolio is performing very well. Good thing we have that put option on the SPY, so that kicked in at 336. So you don't have to stress out about the SPY. You're going to get 336 a share, no matter what, because you followed the system and you bought your insurance, not to get rich, but to protect you when it counts. So overall, the portfolio is doing very well. And I'm going to go ahead and wrap us up here so that we can hop back on with our bootcamp crew in another hour. I've got a few recent articles from Zero Hedge that are trying to look at really short-term data, like coal, electricity, pollution, traffic, things that we can measure very real time. And then we'll flip it through about 100 slides, just bigger picture, 10-year potentially losing control of the two currencies, the yuan and the Hong Kong dollar. Any last questions? And if you are in the boot camp and can't make it today, don't worry, you'll get the replay.
Hey, Jason, this is Mark. Just want to let you know, I just got the link for the boot camp, so I'll be there.
Okay, great. Sounds good. Looking forward to it. All right, great, guys. Well, thank you so much for your time, and we'll see most of you in an hour, okay?